If you had the chance to invest in the exact same energy companies that large institutional investors are quietly accumulating right now before the rest of the market fully understands what is happening, would you take it or would you wait until the prices are higher and the opportunity is already gone? Because that is exactly what is happening in the energy sector right now. Behind the headlines about inflation, interest rates, and volatile oil prices, a much bigger shift is unfolding. The global energy system is being rebuilt in real time. Electricity demand is accelerating faster than most investors realize, driven by artificial intelligence infrastructure, electrification of transportation, industrial expansion, and massive data center buildouts that require constant and reliable power. Today we are going to break down 3 of the companies that operate across renewable energy, electricity generation, and global energy transformation. Companies that sit at the intersection of stability and long-term compounding growth. Companies that are not just participating in the energy transition, but actively building it. Let's start with the first one. Brookfield Renewable, ticker symbol BEP. Brookfield Renewable is one of those companies that most investors hear about but very few truly understand at a structural level. Because this is not just a renewable energy company, it is a global infrastructure owner with a massive portfolio of long-duration energy assets that generate predictable cash flows across multiple continents. Hydroelectric plants, wind farms, solar installations, energy storage systems, all operating under long-term contracts that are designed to produce steady revenue over decades rather than years. And this is where the first major advantage shows up. Most companies in the energy space are exposed to volatility. Commodity prices rise and fall, demand shifts with economic cycles, margins expand and contract based on external forces. Brookfield Renewable is structurally different because a large portion of its revenue comes from long-term power agreements. These contracts lock in pricing and provide visibility into future cash flows that resemble infrastructure income rather than cyclical earnings. That alone changes how institutional investors view the business. But the real strength is not just stability, it is scale and acquisition capability. Brookfield Renewable is part of a larger global asset management ecosystem that specializes in acquiring and optimizing infrastructure assets. This means the company is constantly recycling capital, selling mature assets, and reinvesting into higher growth opportunities in renewable energy development. That cycle creates compounding. Buy assets, improve efficiency, expand capacity, reinvest capital, repeat. Over time, that structure allows Brookfield Renewable to grow both its asset base and its cash flow generation without relying solely on organic growth. Now step back and look at the macro environment. The world is facing a structural increase in electricity demand. Artificial intelligence alone is expected to require massive amounts of energy to power data centers that run continuously at scale. Add electrification of transportation, industrial automation, and global population growth, and the demand curve for electricity starts moving in one direction, up. And not slowly. Brookfield Renewable is positioned directly inside that demand curve. Because it does not just generate energy, it owns the infrastructure that produces it. Now here is where the market disconnect becomes interesting. Many investors still treat renewable energy companies as if they are purely policy-driven or interest rate-sensitive stories. But the reality is more complex. While macro conditions do matter, the long-term demand for electricity is becoming increasingly non-discretionary. People do not choose whether they want energy, they need it. And businesses cannot operate without it. That means the focus shifts from short-term pricing to long-term supply security. Brookfield Renewable benefits from that shift because it operates in markets where governments, utilities, and corporations are actively locking in long-term energy contracts to ensure stability. That creates a strong foundation for predictable revenue growth. At the same time, the company continues expanding its global footprint. It is not limited to one region or one energy source. It is diversified across hydro, wind, solar, and storage, which helps reduce concentration risk and increases resilience across different market conditions. And that diversification matters more than ever in a world where energy systems are becoming more complex and interconnected. From a financial perspective, Brookfield Renewable generates substantial recurring cash flow from its contracted asset base. This allows it to fund new developments, acquire additional infrastructure, and continue scaling its renewable portfolio over time. But what really attracts institutional capital is not just current performance, it is the compounding structure. Because once renewable infrastructure is built and stabilized, it can generate cash flow for decades with relatively low incremental cost. That is the definition of long-duration compounding assets, and that is why Brookfield Renewable continues to attract long-term capital even when short-term sentiment in the energy sector fluctuates. Now the question becomes whether the market is fully appreciating the scale of what this company is building over the long term, because if electricity demand continues to accelerate the way current trends suggest, Companies like Brookfield Renewable may find themselves sitting at the center of one of the largest infrastructure expansions in modern history, and that is only the first company. Before we move on, let's lock in the engagement layer. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Now we move into a company that sits at the very core of the United States energy system, but is often misunderstood because people still think of it as a traditional utility. In reality, it has quietly transformed itself into one of the most aggressive renewable energy builders in the entire global market. NextEra Energy, ticker symbol NEE. NextEra Energy is one of those rare companies that has managed to combine two things that usually do not coexist in the same business: stability and high growth. On one side, it operates a regulated utility business that provides electricity to millions of customers. This creates predictable, steady cash flow that behaves like a defensive asset during uncertain economic periods. On the other side, it has built one of the largest renewable energy development platforms in the world, with massive investments in wind and solar generation capacity that continues to expand year after year. This dual structure is what makes NextEra different. Most utilities grow slowly. Their earnings are tied to regulation, infrastructure constraints, and incremental demand growth. NextEra broke that pattern by treating renewable energy development as a long-term growth engine rather than a side business. And that shift is where the real story begins. Because while many investors still think of utilities as low-growth dividend plays, NextEra has consistently outpaced that perception by aggressively expanding its clean energy footprint at scale. It has become one of the largest producers of wind and solar energy globally, not just in the United States, which gives it a structural advantage in both cost efficiency and project execution. Scale matters here more than almost anything else. The more renewable projects a company builds, the more it learns how to build them efficiently. The more efficient it becomes, the lower its cost structure, and the lower its cost structure, the more competitive it becomes when bidding for new long-term energy contracts. That cycle reinforces itself over time. Now zoom out and look at the broader energy landscape. Electricity demand is rising for reasons that are no longer cyclical. They are structural. Artificial intelligence is one of the biggest drivers. Data centers require enormous amounts of power and operate continuously. Electrification of transportation adds another layer of demand. Industrial automation and reshoring of manufacturing further increase energy consumption. Even basic population and economic growth contribute to the upward pressure. What this means is simple. The world needs more electricity than ever before, and increasingly, that electricity is expected to come from renewable sources. NextEra sits directly in that intersection. The company's renewable division continues to expand its wind and solar portfolio, which allows it to lock in long-term contracts that provide stable and predictable revenue streams. At the same time, its regulated utility operations provide a foundation of consistent cash flow that supports further investment into renewable expansion. This balance between stability and growth is what makes the business model so resilient. Now let's talk about the competitive advantage. Building renewable infrastructure at scale is not easy. It requires access to capital, regulatory expertise, engineering capability, and long-term planning. NextEra has spent years developing this expertise, which gives it a significant advantage over smaller competitors that are still trying to scale up. It also benefits from cost leadership. Because of its size and operational efficiency, NextEra is often able to generate renewable energy at lower cost than many of its peers. That allows it to win more contracts and reinvest more capital into future projects. That is how dominance is built in infrastructure businesses, not through one breakthrough moment but through consistent operational advantage that compounds over time. From a financial perspective, NextEra generates strong and stable cash flows from its utility business while simultaneously reinvesting heavily into renewable energy projects. This creates a long-term growth runway that is unusual for a company of its size and maturity. It is also one of the reasons institutional investors continue to hold it as a core energy position, because in uncertain macro environments, assets that combine predictable income with long-term growth exposure become extremely valuable. NextEra fits that profile. But there is another layer to consider. As global energy systems shift toward renewables, companies that already have large-scale renewable infrastructure in place gain a significant advantage. They do not need to wait for the transition. They are already inside it. NextEra is not preparing for the energy transition. It is already operating in it. And that distinction matters more than most investors realize. Because the market often prices companies based on where they are today, not where they are structurally heading over the next decade. NextEra's positioning suggests that its long-term role in the energy ecosystem may be far more important than its current valuation reflects, and that is exactly why it continues to attract attention from large institutional investors who are looking beyond short-term cycles. Now, before we move into the final company, we are going to take a quick step back and bring this together. Brookfield Renewable is a global infrastructure owner building diversified renewable assets across multiple continents. NextEra Energy is a utility-scale renewable powerhouse dominating electricity generation in the United States. Both are aligned with the same macro reality. Electricity demand is rising and renewable energy is becoming the dominant source of new capacity. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's move to the final company. Total Energies, ticker symbol TTE. Total Energies is one of those companies that forces investors to rethink what the energy sector actually looks like over the long term. Because while many people still separate energy into clean versus traditional, companies like Total Energies operate across both worlds at the same time. It is a global integrated energy company with massive operations in oil and gas, but what makes it especially relevant today is its aggressive and structured transition into electricity, renewables, and low-carbon energy systems. This is not a symbolic shift. It is a capital allocation shift at global scale. The company has been steadily increasing investment into solar, wind, LNG infrastructure, and electricity trading platforms, positioning itself as a diversified energy provider rather than a single-source commodity business. And this matters because integrated energy companies have a structural advantage that pure-play renewable companies often do not. Cash flow stability. Total Energies generates massive operating cash flow from its legacy energy operations. That cash flow acts as a funding engine for its transition strategy. Instead of relying heavily on external financing, it can internally fund renewable expansion while still returning capital to shareholders. That flexibility is extremely powerful in capital-intensive industries. Now zoom out and look at the global energy system. The world is not transitioning away from energy. It is transitioning toward more energy consumption. Electric vehicles require electricity, data centers require electricity, industrial reshoring requires electricity, artificial intelligence requires continuous power. Even traditional manufacturing is becoming more energy-intensive due to automation. What changes is not the need for energy, it is the source mix, and companies like Total Energies are positioning themselves across that entire mix. This is where its global scale becomes important. Total Energies operates across multiple continents, giving it exposure to different regulatory environments, demand profiles, and energy pricing structures. This diversification reduces dependency on any single region and allows it to optimize capital allocation globally. At the same time, it is building out renewable energy capacity alongside its traditional operations, creating a hybrid model that blends legacy cash flow with future growth potential. That combination is rare in the energy sector. Most companies are either fully legacy or fully renewable focused. Total Energies sits in between, which gives it flexibility during the transition period. Now let's talk about why institutional investors pay attention to this structure. Large energy transitions do not happen overnight. They take decades. During that time, companies that can operate in both old and new systems tend to outperform because they are not forced into a single direction too early. They can adapt as conditions change. Total Energies is essentially hedging the energy transition while also participating in it. That means if oil and gas remain strong longer than expected, it benefits from its legacy assets. If renewables accelerate faster than expected, it benefits from its new investments. That optionality is valuable. From a financial perspective, the company generates strong and consistent cash flow from its global energy operations, which supports both reinvestment into renewable infrastructure and shareholder returns. This balance between legacy strength and future positioning is one of the reasons it remains relevant in global energy discussions even as the industry evolves. But there is another layer that investors often overlook. Scale in energy is not just about size, it is about integration. Companies that can control multiple parts of the energy value chain, from production to distribution to electricity markets, tend to have stronger long-term positioning because they can capture value at multiple points. Total Energies is actively building toward that model by expanding its presence in electricity generation and trading, which moves it closer to becoming a fully integrated energy and power company rather than just an upstream producer. Now step back and look at all three companies together. Brookfield Renewable focuses on owning and operating renewable infrastructure globally. NextEra Energy dominates renewable electricity generation at utility scale. Total Energies is transforming into a diversified global energy provider bridging traditional and renewable systems. 3 different strategies, 3 different structures, but all pointing toward the same macro reality. The world is going to need significantly more energy, not less, and the companies that can supply that energy reliably, efficiently, and at scale are the ones that are likely to benefit over the long term. Now the real question is this: if energy demand continues to accelerate due to artificial intelligence, electrification, and global industrial expansion, which of these 3 models do you think will capture the most long-term value, and why? Let me know your thoughts in the comments. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.